Welcome back. Now it's time for our weekly energy update with Dan McTeague, President of Canadians for Affordable Energy. All yours, Dan.
Very much for that, Teresa. And yes, we are speeding very quickly to the end of summer. Looks like it's the last full week before we start sending the kids back and life gets back to normal. We start getting back to work. Hopefully that will be a sign of things to come because it looks like energy prices are going to be very, very bullish for the foreseeable future. This has been an unusual week because we've seen oil drop to the high $71 a barrel for WTI. But, earlier in the week, $74, $75 a barrel. It looks like we're heading right back there. Much of this based on the recognition that what we're seeing here in Canada is very reflective of what we're seeing across the country. Prices have actually dipped, something you don't see for this time of year. We haven't seen much in the way of any meteorological events. There's been no hurricanes that have really impacted U.S. supply. And other than a couple of refineries in the U.S. Midwest, both in Chicago and Ohio, having run into some trouble, we haven't really seen much in the way of any expectations as to a drop in supply. What is important to recognize is that this week we saw a significant drop in oil inventories in the United States, a little bit of gasoline, a little bit of diesel as well. But what that's done is not caused any type of interruption as far as gas prices are concerned. In fact, prices have fell, and they fell mostly because the U.S. Department of Labor decided that they might want to revise. Some have referred to it as a lie. But whatever reasons were behind the big mistake of underestimating 818,000 people that work in the United States, it may very well bode, very bearish for energy prices in the future. We also have indications that the U.S. Central Bank, the U.S. Fed, Jerome Powell, who's meeting today in Jackson's Hole in Wyoming, has indicated that he is definitely going to be moving towards a cut in interest rates, whether that's a quarter or half point. I think most are leaning to a half point. That could be a bearish sign as well, or even a bullish sign for energy prices, because of course it means that as you drop interest rates, there is more money in the pockets of ordinary people, especially in the United States. We've seen a half point cut in Canada, where of course inflation is becoming less and less of a concern. What that means is across Canada, I would expect this week an average of about a 4-cent increase as the market begins to readjust itself and to properly price out energy prices. So British Columbia will see prices move up towards the $1.76, $77 range, up 3 cents a liter, including Vancouver. For Alberta, look for prices that have been in the $1.50, $1.45 range to move up about 2 cents a liter. Saskatchewan, I don't see any change whatsoever, nor do I see any change for Manitoba. What Manitoba will have to face, though, is a decision as to whether they're going to continue suppressing the provincial sales tax on gasoline, which is about 14 cents a liter plus GST. And of course, for Ontario, which is in the 160 range, the low 160s, I would expect the high 150s. The prices will move up about 4 to 5 cents a liter this week as we head towards Labor Day weekend. Same for Quebec, which is always 9 cents a liter more expensive than Ontario. And the Maritimes, which saw a big decrease this week, look for them to see prices move back up. That is also another factor that I want to raise, because in a couple of weeks, we'll be talking to Teresa about the fact that we're going to be switching from summer blend of gasoline to winter blend of gasoline. You recall that caused about a 14 cent a liter increase across the country. Look for that to reverse itself now that we're using less expensive to make gasoline, winter spec gasoline. We could see an 8 to 10 cent decrease. But the story for the summer of 2024 is that energy prices have been significantly undersold. We've ignored fundamentals. We've ignored geopolitical tensions. We've ignored and perhaps skirted meteorological considerations. And other than the two refineries that ran into trouble in the U.S. Midwest, we've had a fairly quiet summer. One thing is very clear. Demand is robust. It remains strong. And supply is not meeting that demand. Sooner or later, we're going to see a correction in the market to the upside. And what that means is that higher prices for energy for most Canadians when they least expect it. At this time of year, it's important to note that we do switch from reliance on gasoline to more emphasis on diesel. Not only are, of course, farmers removing and harvest, but we're also seeing diesel as a price proxy as a result of its use for home heating fuel. So what that's going to mean is that diesel prices are going to start to overlap and substitute gasoline. As gasoline drops a little bit, diesel prices will start to go up. That's the story for the end of the summer of 2024. We'll talk to you next week, Teresa. Thanks for having me.